Hello there. Welcome to The Open right here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Shares in Intel under pressure in the pre-market after a report that NVIDIA has halted a test to use Intel's production process to make advanced chips. Reuters says NVIDIA tested the so-called 18A process but stopped moving forward. In September, NVIDIA agreed to invest $5 billion US in Intel after the US government's decision to take a stake of roughly 10% in the company. However, that deal did not include a commitment for Intel to make NVIDIA chips. First Quantum Minerals has agreed to sell the Cobre Las Cruces mine in Spain to Global Panduro for up to $190 million US, plus additional payments tied to profit. Global Panduro says the deal will enable it to further develop the Las Cruces polymetallic primary sulfide project. Shares in Dynavax are soaring almost 40% in the pre-market. Sanofi has agreed to buy the drug maker for about $2.2 billion US as it seeks to expand in vaccines. The deal gives the French drug maker a hepatitis B vaccine that's already marketed in the US. The announcement comes as Sanofi continues to face challenges, including a rejection by U.S. regulators for its experimental multiple sclerosis drug. And it looks like we are going to get a marginally higher open for U.S. tech stocks today. The S&P flat, but it closed in pre-market trading, but it closed at a record high yesterday. And the TSX also settled at a new all-time high. There's a look at how it traded yesterday. It's up more than 30%, excluding dividends, in the past 12 months. And let's see how oil has fared. It has had something of a rally over the past couple of sessions, still mired below $60 US. Gold has been hitting fresh records today. There's the February futures blasting above 4,500. So the precious metal trading in record territory once again. Let's see how the Canadian dollar is doing. It too has had a rally over the past few sessions. A big part of that, of course, is the fact that our central bank seems to be done for quite a while now with cutting interest rates, whereas the Fed is expected by many observers to go on reducing borrowing costs. That tends to weaken the currency. And finally, let's have a look at Bitcoin. It's surged to record highs this fall amid signs that the Trump administration is on side, an aggressive booster of cryptocurrencies, but it has dropped off over the past couple of months. It's been a great year for stock market investors. Toronto up about 30% this year. We're joined by Javed Mirza, quantitative and technical strategist at Raymond James. Javed, great to see you, and thanks very much for joining us.
Thanks so much for having me. Always great to see you, Andrew.
Let's put up a 5-year chart, if that's okay, if that works for you, for the TSX Composite. Well, what does that chart say to you right now, Javed?
Look, we're very constructive, especially heading into next year in terms of where we are in the market cycle model. Andrew, if you recall at the start of the year when we met, we were talking about that bigger corrective phase we were looking for at some point in 2025. We think that's what we saw from from February to April of this year. Now that we're through it, in our view, we're starting a new 4-year cycle, or essentially a 3 to 5 year cyclical bull market. So the last one we saw was from, call it 2018 to 2022. Then we had that 4-year cycle reset, call it through the bulk of 2022. Now we think it's smooth sailing at least into the second half of 2027, first half of 2028.
I mean, yeah, we're looking at a 10-year chart here. And these are not logarithmic charts, I know, so they can exaggerate the upward march. But the market's going nearly vertical over the past couple of months.
Yeah, and in our view, everything that we're seeing happen here in Canada is very positive. We're seeing the build out of infrastructure, opening of trade, not just focused on the south of the border, but also east and west. And especially, and you mentioned this before when you're talking about gold, we're seeing this bigger shift and longer term secular shift that is taking place here into hard assets. So natural resources, that is going to be very bullish for Canada and for the Canadian dollar as investors look to flock to a country like Canada that has such strong regulation and rules and that protect investors. And as a result, we think we're going to continue to see foreign investors and foreign capital flow into Canada. That's why we think we're seeing the Canadian dollar rally here as well.
What about, maybe we can put up a 5-year chart for the NASDAQ 100 as a measure of tech stocks. It is still marginally down from its October 29th record high, the NASDAQ 100. What is the story there? Is it a risk that that big rally could be broken?
So ultimately, our longer term view since we've been had taken over the analyst role back in 2011 was that we were in a secular bull market in equities that should have upside by time into 2030. So that's a long-term secular driver of stock market strength, and that should be led by information technology. So I think we're coming towards the end stages. I do think there's probably another 3 to 5 years of upside here, but what we are seeing, and I'm sure you've been seeing it as well, Andrew, is over the last month and a bit, is we've seen a rotation out of the Mag 7 and a broadening of the rally. So if you can pull up the Russell 2000, what you can see there, that is the U.S. small caps, is that they're actually breaking out to new highs, which is very positive. So we're seeing a broadening of the rally, and that really lines nicely or dovetails with our view that next year should be a rotation into phase 2 of the market cycle model, which should be beneficial for industrials, basic materials like copper.
Yeah, we're having a bit of trouble with the Russell 2000, but that is interesting the way it's been hitting record highs over the past while. What about oil? Maybe we could throw up a 5-year chart for oil. What story is that telling you, Javed?
Yeah, great question. So, I mean, we've seen gold run, we've seen copper run. Crude has really lagged. At the start of October, in our last quarterly note, we highlighted that we thought there was going to be a nice seasonal trade in natural gas. That has moved as well, but WTI has remained sluggish. So what's really interesting, though, is that commercial hedgers in the futures market, they're the producers. They're typically known as the smart money. They're actually pretty long WTI crude here. So normally when you get this kind of setup, that typically suggests you're going to see a nice intermediate term, call it 3 to 6 month rally in crude. So I really like the reward risk ratio here on WTI. I think it's compelling. And yeah, that's, I think, definitely a place investors should be looking.
Give us your view on say, silver, because silver has just gone exponential this year, as you know, up something like 150%, almost 140% in the past 12 months. What about silver? Is there a risk there that it's overbought, just excess euphoria?
Yeah, so in the same way that we were talking just now about the commercial hedgers or the producers being essentially long WTI crude, commercial hedgers in silver and gold have been reducing their risk exposure, i.e. they're hedging more. So that is a bit of a risk. I mean, if you just look at that chart, it has gone parabolic. So we've been talking about this longer term secular shift that we think is underway, but I definitely, from the way that this chart is looking, there's definitely a period of consolidation that is likely required. So it is a bit accelerated and extended at these levels. You're
a bit wary there. Yeah. Maybe we could put, I'm not sure this ETF is working for us right now, TLT. It's an ETF, as you probably know, that measures the US 20-year bond yield, or the price of bonds in the US, I should say. Bonds, do they look attractive right now in terms of possible capital gains over the next year or two?
So, we've been talking for quite a while. You know our view that ultimately we think interest rates are headed higher, and we think that they are in a new secular uptrend. And so if you pull up a longer term chart, maybe we could get this for 10 years. And what you'll see here is that the TLT peaked back in 2020 when rates bottomed essentially at zero. And in our view, that is a longer term secular peak. So what you can see here is we've had that big downdraft from 2020 all the way to 2023. Then we've been in this sideways trading range. If we're correct on our longer term market call, we think bonds, as represented by the TLT here, is likely going to remain in this sideways trading range, likely into 2027. But at that point, we think inflation is going to pick up. The Fed is actually likely going to hike again. And then that is going to cause the TLT to head lower as interest rates head higher. So if we were looking to, look for a bond proxy, we would prefer something like real estate, or what we've been telling clients is we think energy is the new utilities. A lot of these energy stocks have pretty strong dividend yields, and they're inflation protected. So if I was looking for income and I was retired, I'd be looking at some of these energy plays with strong or high dividend yields.
Thank you very much, Javed. Really appreciate it.
Happy holidays, Andrew. Thanks for having me.
You too, Javed. Javed Mirza, quantitative and technical strategist at Raymond James. Coming up, we'll tell you how U.S.-Venezuela tensions could affect Canada's energy sector. There's growing tension between the U.S. and Venezuela, and that has raised questions about access to the South Americans' gigantic oil resources. Canada, and specifically our energy industry, could be affected. CTV's Jeremy Sharon has more in this report.
Off the coast of Venezuela, sanctioned oil tankers have become the target of U.S. authorities. 2 have been intercepted and seized already, along with millions of barrels of oil, and Washington says it's after more.
Maybe we'll sell it, maybe we'll keep it. Maybe we'll use it in the strategic reserves. We're keeping it. We're keeping the ships also.
The U.S. has increased its military presence in the Caribbean Sea. Trump ordered a blockade last week, calling it the biggest armada the U.S. has ever had in South America. Today, Venezuelans hit the streets in protest of the U.S. president they called Pirate Trump, who Monday had this warning for Venezuelan President Nicolas Maduro.
He can do whatever he wants. It's all right. Whatever he wants to do. If he wants to do something, if he plays tough, it'll be the last time he's ever able to play tough.
Meanwhile, the tension could have implications for Canada.
Venezuela has some of the largest oil reserves in the world. They're primarily heavy oil and bitumen, which are very much like what Canada's reserves are here in Alberta in the oil sands.
Political instability in Venezuela has given Canadian oil producers the advantage, but if that changes, it could mean increased competition.
This makes it all the more important for us to think about sending our oil again to the Pacific, to a Northwest Pacific pipeline, knowing that the Asian market is growing.
Trump's interest in Venezuelan oil could eventually force a fight for access to the U.S. market. But the question is,
how long would it take to build the projects that could start to displace Western Canadian oil? And I think that would take a long time.
That means time is in Canada's favor. And in the short term, Trump's blockade could actually increase demand for Canadian heavy crude. But it could also lead to uncertainty and price volatility in the market.
Up next, we're going to check out some of the top newsmakers this year when it comes to trade. We'll be right back.
Hi, Hi there, I'm Lindsay Biscaya and joined with BNN Bloomberg's Andy Bell and Derek DeCluitt, executive editor at Bloomberg News Canada, for a look back at some of the big news stories, big news makers of the year. So we'll get started with the first one. Obviously, we can't really think about 2025 without thinking about trade, tariffs, the ongoing kind of trade dispute that Canada has with the U.S. So Derek, I guess I'll start with you. Obviously, many sectors hit hard by this. You don't want to compare one against another, but one of the industries really hit hard was the auto sector. What do you think happened throughout the year to that sector?
So in the middle of March, Donald Trump, in one of his famous Truth Social posts, said he would like to permanently shut down the Canadian auto industry. It was part of the dispute that he was having with the Ontario Premier, and Justin Trudeau at the time was just on his way out as Prime Minister. And this is like one of the big stories to watch in the trade file for next year, because the auto sector is different than everything else. They can't, the aluminum business is not moving out of Quebec. It's dependent on cheap hydro. The trees are not moving out of British Columbia, and the softwood lumber part is difficult to solve. But these are industries where Canada has an inherent advantage. It's Trump's clear goal to try to get as many auto assembly jobs out of other countries and into the U.S. as he can. And with those jobs, if he's, to the extent that he's successful, go the parts jobs, and that's a massive issue for Ontario going forward.
Yeah, and we've seen that, right? Especially with a lot of layoffs, a lot of changes in terms of production at certain facilities in Ontario auto plants throughout the year. I mean, this is a unique battleground when it comes to CUSMA and the year ahead. That's
right. There's 3,000 people at the Brampton plant that is Stellantis Chrysler, whose futures are very uncertain. There are a bunch of people in Oshawa who are still making pickup trucks, but their futures are somewhat uncertain, as it's not clear what exactly production will look like in a tariff world. This is a totally different one than the one we're accustomed to.
Yeah. And I mean, when we zoom out and look at the impact of the tariff world, like you talk about, Andy, I mean, the red tape that this has created for small businesses across the country is phenomenal.
I was horrified just researching this segment at the amount of extra paperwork small businesses in particular have to do, because now they have to certify that they meet CUSMA. And it's not just as simple as just filling out a form. All of your components of the thing, we're talking about goods here, not services, all of the components have to be certified. And then when you put this thing together, you've got to recertify the whole thing. And that adds friction and costs, very tough on small businesses. Plus, we had that thing where the Americans got rid of the de minimis exemption, whereby small Canadian firms were shipping to U.S. customers. If the value of the shipment was below $800, they could get it into America duty-free. That's gone as well. So small businesses have been a victim here, I think, in particular.
Yeah, definitely. Okay, so I want to talk more about CUSMA in a moment and the renegotiation that we have to look forward to in 2026, what that can mean. But first of all, we can't talk about 2025 tariffs and trade without talking about the number of ads that the Ontario government put out. And of course, the last one that was out later in the year, the Ronald Reagan ad, was very disruptive, you could say. Donald Trump did definitely take notice of that. Before we talk about it, we do have a quick clip of the ad for those who maybe didn't see it. You can hear a little bit of it now. Take a listen.
High tariffs inevitably lead to retaliation by foreign countries and the triggering of fierce trade wars. Then the worst happens.
So Premier Doug Ford standing by this, saying this was the best ad he's ever seen.
It was a smart concept. And it got under the skin of Ford. It was a brilliant idea.
It was a good, it's all about Ronald Reagan, one of Donald Trump's supposedly favorite presidents, talking about how tariffs hurt the U.S. economy. Do you think maybe it obviously made an impact with Donald Trump?
May have backfired, obviously, was Trump claimed that he was calling off the talks because of that ad.
Yeah.
But why did it get under the president's skin? Is because it was true. Because Ronald Reagan was mostly a free trader. And of course, that ad is taken from an address where he's trying to explain to the public why he's taken a trade action against Japan many, many years ago, but still believes in the principles of free trade. It was a real hot button.
Yeah. And the idea was to kind of target other Republican leaders throughout the country, get them thinking about it, and maybe go to the White House and talk a little bit more about whether this is the best idea forward. I'm not sure whether that worked or not, but it was definitely a moment this year in 2025 when we're talking about tariffs.
And people, I tried to track whether was there any case in which they distorted the former president's words, and I don't think they did. I mean, obviously, with any kind of clip like that, they took bits and pieces from here and there, but I think they fairly reflected what Reagan had said.
It was mostly in context, yeah. Okay, so looking ahead to 2026, Kuzma, and looking back on the year that just passed, we've got the renegotiation of Kuzma coming up in 2026, that free trade agreement between Canada, the U.S., and Mexico. But first of all, let's talk about, I'm not sure who wants to pick up on like how important this free trade agreement was for Canada when it came to a buffer with a lot of industries against tariffs.
It was, really. I mean, we do have among the lowest tariffs of any country trying to get stuff into America now, apart from steel, aluminum and lumber, and autos have been hit to some extent. So CUSMA has been a major safety factor for Canada in this current trade disruption.
And I think to Andy's earlier point about there's a tremendous paperwork burden, especially on small and medium-sized businesses, but by and large, they went through that. And so more than 85% of what's shipped now from Canada to the U.S. does meet that compliance test. And that's really a big part of the reason why the Canadian economy held up reasonably well, certainly probably much better than most economists thought it would, back in March and April when the trade war was sort of really starting to heat up.
And it may turn out that Mr. Carney, the Prime Minister, has played this pretty well. I mean, it's always hard to know, but after talk of elbows up and our relationship with America is broken or certainly transformed, he then backed down. He dropped retaliatory tariffs. He backed down on the digital services tax. And that led to a fairly small tariff burden on Canada. I mean, it's hard to attribute exact cause and effect here, but it looks like he may have handled it well. It's
hard. Yeah, he's keeping things very quiet, a very small group around those negotiating tables when they were happening. So it's hard to know, but yeah, you can take hints from that. Okay, then let's talk about 2026. I mean, there's the renegotiation coming up. How important is this, that we keep a lot of what the current free trade agreement has intact?
I mean, it's really vital. And of course, there are certain sectors, we've mentioned autos, but more broadly, the manufacturing sector, I think, is one of the most under the gun. I think one of the things to really look for is the Trump administration is being quite vague about what they want, and that's by design. For them, uncertainty, keeping it's part of the Trump playbook, keeping your opponents on their toes, but also, as long as there is this uncertainty, companies that want to invest will be more likely to say, well, I'll just invest in the U.S. because then I'm assured of access to that market. And the more that they can keep a cloud of uncertainty around what's going to happen to Canada and Mexico, the longer that goes on, the harder it is for those countries, our country, to draw investment.
It is going to be hard, obviously, for Canada to build markets around the world. This country's been talking about that for decades, diversifying trade. But America is so much the natural trade partner, if only because of geographical proximity.
Okay, we'll have to wait and see what happens there. Good conversation. Thanks, guys.
Thanks.
Thank you.
And stay with us. We'll be right back right after this.
Let's get trading going on this Christmas Eve. Ringing the bell at the NASDAQ, the Girl Scouts of Greater New York. At the New York Stock Exchange, it's the NYSE trading floor ops team doing the honors. It's time for the first 15. And let's see how the big North American benchmarks are doing. We're slightly down. To begin the morning, remember both the TSX Composite and the S&P 500 hit record highs yesterday. The NASDAQ Composite is hanging in this morning, but market's pretty flat. A lot of people just taking the day off as, of course, they get ready for the big holiday, the peak of the holiday tomorrow, Christmas Day. Let's have a look at some stocks of interest here. First, Quantum. It's had a great year, that stock. On hopes that it will get to reopen its huge mine in Panama, announcing a deal to sell a mine in Spain. And investors who were smart enough to buy First Quantum after it lost control of Cobre Panama have made plenty of money. Panama itself seems interested in getting that giant operation going again. Let's have a look at Agnico Eagle as a proxy for the gold stocks. It is down today, which is interesting, with gold hitting a record high. Of course, those shares have soared over the past 2 years. Agnico, where is it now? About 246, 247, is down from a high in mid-October of just north of $261. But it's been an incredible performer this year. Some analysts have pointed to a hefty valuation. That stock up 120% in 2025. And let's have a look at Nike. That stock was a little higher in the pre-market. Tim Cook, the boss of Apple, a sharp cookie, to put it mildly, filing indicated that he bought $3 million worth of shares. Of course, that's just chump change for the likes of Tim Cook. He's been a director, though, of Nike since 2005. And let's have a look at Celestica, because that's been a major winner on the TSX this year. The stock is off its highs, but still up as of this morning, 213% in 2025. Kinross has been an incredible performer as well. That stock is up threefold, up just over 200% this year, slipping a little in early trading. And losers in Toronto, Constellation Software. Oh my goodness, look at that. Down well over 20% this year. It's not alone. We've seen quite a few of these conventional software firms dropping amid fears that AI will hollow out their business, that you won't need to be hiring as many programmers, for example. And Thomson Reuters also down. It's been a favorite blue chip for many years, but that stock down more than 20% as well. In part, it seems because of concerns that AI will mean big changes in the database business. They are, of course, giant vendors of information. Let's have a quick look at the European markets. A lot of focus here in that part of the world on, is there any progress in ending that awful war in Ukraine, the war launched by Russia's leader, Vladimir Putin. Russia, according to a Bloomberg report today, is seeking key changes to the latest U.S. peace plan, including more restrictions on the Ukrainian military. And apparently this 20-point plan put forward from the United States is viewed in Moscow as a starting point for further talks. The big thing for Russia, or a big thing, further guarantees against eastward expansion by the NATO military alliance. And let's have a look at Asian markets. There is something of a military story there as well. According to a Pentagon report publicly released, the Chinese are in the midst of a, quote, historic military buildup that has made the United States domestically increasingly vulnerable. And this is a congressionally mandated report posted on the Pentagon website. It is the first issue during this Trump administration, and it talks about the Chinese military becoming increasingly sophisticated and learning lessons from Russia's setbacks in Ukraine as Beijing increases pressure on Taiwan. Up next, from grounded flights to delayed mail, and work coming to a standstill at some of Canada's ports. 2025 has been remembered as a year of labour disruptions. That's ahead. Canadians have weathered a lot this year, including Trump's tariffs. But in 2025, workers were among those making the biggest noise. We're talking about stalled flights, delayed mail, empty classrooms. There were strikes across the country. CTV's Kathy Lee has more on this labour unrest and why so many workers are saying enough.
The soul of Canada's workforce rose to the surface on picket lines marked by tired feet and a demand for something better.
We're striking to keep good service and to keep good jobs. We will be here until we win.
Years of built-up frustration spilling into the streets from coast to coast. A chorus of unrest, grounded flights, slowed mail delivery, and emptied out classrooms in Alberta.
We're in a place where we've got a broken system. It's sick. It's been death by 1,000 budget cuts.
The summer of labor unrest begins on August 16th, with more than 10,000 Air Canada flight attendants walking off the job for 3 days, after a new negotiated agreement with their employer fell through.
Starting flight attendants now are making $1,900 a month in an area where rent is $2,000.
In addition to wages, at issue, employment conditions, work rules, and unpaid hours.
We're not paid anytime the aircraft is not in motion.
Pay, one of the sticking points behind the 2-week nationwide postal strike on September 25th.
Fair wages, improved health and safety, expansion of the public service, and a right to retire with dignity.
Workers also motivated to go to the picket lines after the federal government announced an end to door-to-door delivery in an effort to save a struggling Canada Post. The disruption impacting many businesses relying on the delivery service.
There's been some delays in sending out packages, and we have had to use alternative services at times.
We've essentially just have lost confidence in Canada Post.
And Alberta teachers losing confidence in the education system.
Why does Alberta, the richest province, have the poorest funded classrooms?
Tens of thousands of educators walked off the job on October 6th, wanting better wages, more support, and smaller classroom sizes.
Having to teach 37 grade 6 kids, it's too much.
We are burnt out, we are broken, the kids are not getting what they need.
Only to be forced back to work 3 weeks later after the province invoked the notwithstanding clause, overriding some rights and freedoms to pass the back to work legislation.
This has been the longest education strike in Canadian history. We were looking for a way to bring some finality to it.
The move galvanized students province-wide to walk out of their classrooms.
We're not walking out because we don't care about school. We're walking out because we care too much. We care too much to stay silent.
The students here are angry. You could really feel the emotion in the air because their teachers aren't able to strike. They've taken matters into their own hands, and they want the government to listen. They want to be heard.
Pay our teachers and give us the education we deserve because this isn't fair.
An expert says the level of recent labor disruption and strike activity across Canada hasn't been seen since the 1980s.
Workers engage in this kind of labor activism when they've been pushed too far, when they're fed up. And so they start to push back. I think what we saw in the last couple of years is a significant shift in workers' ambitions. They wanted more because of COVID, followed up by inflation. I think that really ramped up workers' expectations.
And although the strikes have caused chaos, public support for workers remained strong, even among hundreds of thousands of stranded Air Canada passengers.
I think it's okay for these guys to keep fighting.
They're asking for the bare minimum, and I think that they deserve what they're asking for.
As for what comes next for the labor unrest, no one can say for certain. But experts believe this year wasn't an end, but a beginning, a workforce finding strength, and a movement that will carry on. Kathy Lee, CTV News, Calgary.
Yesterday on Market Call, we were joined by Jason Del Vicario, Portfolio Manager at Hillside Wealth Management, IA Private Wealth. The topic, North American global stocks. His top ideas, Novo Nordisk, Constellation Software. We just mentioned it sagged this year. And Plover Bay Technologies, a Hong Kong listed stock. Today on the show, it's Paul Harris of Harris Douglas Asset Management. And he'll take your questions on North American and global stocks. Up next, we saw plenty of interest rate cuts this year. We'll have more on that, how that made the news in 2025.
Hi there, I'm Lindsay Biscaya, joined by BNN Bloomberg's Andy Bell and Derek DeCloet, executive editor of Bloomberg News Canada, talking about some of the big newsmakers of the year, including interest rates, which was of course, a big discussion. So, Andy, I'll start with you. There's been 9 interest rate cuts since June of 2024. And low interest rates, of course, can help in some ways, but they can also cause some problems as well.
They can lead to real estate bubbles. And it's interesting how the housing market has not recovered to any great extent, despite this huge drop in interest rates. So, well, of course, we're here in Toronto, centre of the universe. We know the condo market's in free fall. But across the country, we haven't seen much of a rebound. House prices nationally, insofar as you can measure them, are still down year over year. So there hasn't been a big rebound in housing.
And you mentioned like ultra cheap mortgages weren't hit as hard as previously expected either.
Right. I mean, one of the big questions for the economy coming into this year was what would happen to all these people who got 5-year mortgages in 2020 when rates got dropped, to almost zero and had to roll them over at higher rates. And because the Bank of Canada began cutting last year, I mean, there's pain out there, and obviously people who got a little bit too much debt, who had to roll over their mortgages at 5 or 6%, they're really feeling it. But that's not widespread enough just yet to have had like a major impact on the economy. So we see when we look at the data on, for example, mortgage delinquencies and who's falling behind, the numbers are going up, but they're still kind of below where they were, sort of right before the pandemic. So there's real pain for some households, but it's still somewhat limited, partly because rates got dropped fairly quickly.
And probably before we really see rising delinquencies, we'd have to see a major deterioration in the job market. Now, I know it's gone soft and unemployment's been going up, but we haven't seen mass layoffs in the economy.
Yeah. And when it comes to consumer spending as well, right? Like retail sales, I know a lot of earnings coming in the end of the year. We're talking about like the consumer spending, especially high income consumers, not really impacted by what we're seeing. Was that a surprise to either of you? Derek, I'll start with you.
Yeah, I mean, the consumer generally in Canada holding up a little bit better probably than we thought. And certainly people at higher incomes, they're having really no trouble at all dealing with inflation. But and the median consumer is probably a little healthier than we would have expected. So why is that? I mean, inflation's gotten back under control. Food prices and restaurant meals and so on. There's still, there's a bit of sticker shock there, but in total, things are a little bit better. And wages have been decent, not outstanding, but a lot of people are kind of able to keep up. They're not really able to get ahead. But many households have been able to sort of keep up and keep spending at some level. Like it's not like it's a retail bonanza, but it's been not bad.
On the weekend, I asked Grok, the AI program, any deals on blue cheese in Toronto? And it came back with some guidelines. I won't say it struck gold for me, but it is going to be interesting to see AI. It will empower consumers to some extent, but it will also empower companies to put in adjustable, what's the word, floating rate pricing strategies.
Yeah, dynamic pricing.
Dynamic,
yes,
that's it.
We're bound to see some of that.
Yeah, where with the speculation, even an individual consumer shopping online, they'll say, oh, well, she makes a good buck, we'll charge her a bit more.
Interesting.
I mean, there's been moves to restrict companies from doing that, but AI is going to be a tool for both businesses and consumers trying to squeeze the most profits out of each other or get the biggest bargains.
Yeah, it's going to be interesting to see the role that plays even just in 2026, right? It's happening so fast.
It'll be interesting as well, say you get a plumber over and he or she says, well, you're going to need to replace all that. But maybe I can get my AI to say, well, no, apparently you can just replace a thing like that, a flange or a valve. So it will be fascinating to see how it will really empower us as consumers.
Yeah, you can be the expert kind of when there's AI involved. Okay, well, going back to rate cuts, right, and the number of rate cuts we saw this year, bank stocks earnings doing really well to end the year.
The whole bank stocks hitting records. Yeah, I mean, lower interest rates generally good for them because they borrow short, and so they bring down their deposit rates with their loans or longer term. And the good old Canadian banks, I sometimes wonder, should investors just put all their money into Canadian banks and forget about it? Because in retrospect, that would have been a great strategy for 10 or 20 years.
I mean, the Canadian bank group is up. The stocks are up 40% this year. It's going to be the biggest year since 2009, which was the financial crisis sort of bounce back year. 15% earnings growth, but it wasn't really just interest rates that went right for them. Kind of everything went right for them. The consumer held up better, so loan losses were better. The markets were volatile, partly because of trades. They made lots of trading revenue. And then at the end of the day, the TSX is up close to 30%. And that means wealth management revenues and brokerage fees and all these sorts of things. It was a year where they had so many tailwinds, not all of which we thought they would have at the start of the year, the banks.
Yes.
Maybe getting some unwanted attention at times, though, the big banks, right? I can't remember, was it September or October where Carolyn Rogers from the Bank of Canada called the Canadian big banks an oligopoly?
That was extraordinary, I thought. A top person at the Bank of Canada coming out and saying that she felt that more competition needed. And in the budget, the federal budget, the government indicated they want to look at improving competition in the sector. But of course, the lobbying power and political power of the big banks will delay any moves, I think, there.
Well, I think there will be efforts made under this government. I mean, they've been pretty clear to make financial technology companies more able to compete. But in Canada, we're always caught between this desire for competition and the desire for really stable, healthy banks that can lend in hard times. Yeah. And that's part of the reason why we've allowed them as a country to get so big, is that they do provide, that level of stability and the balance sheets that can lend if things get really hard.
When we're talking about lower interest rates, which is obviously what we're seeing now, Andy, you flagged something is that we're not seeing a lot of businesses investing in Canada despite these lower interest rates.
No, and I mean, of course, the uncertainty over tariffs, you can't blame firms, but this has just been a perennial problem. Canadian companies just don't seem willing to invest in technology or training or capex. Whether there's something wrong with the culture but this slow rate of capital formation has been plaguing our economy for years.
Is it just too early, though, Derek? Do you think maybe we'll see some changes in 2026?
Well, it does take a little while for regulatory changes, which we're seeing, especially in the resource sector under the Carney government. It also takes a while for rate cuts to sort of fully work through the system. Right. We had a full percentage point of rate cuts from the Bank of Canada this year. Usually it takes kind of a year or so for that to show up. So, but mostly what Canada needs to get that investment is higher growth rate, and that will bring business confidence, and with confidence will come investment.
Before we wrap up, does anyone want to wager a guess in terms of what we could see in 2026 with rate cuts, rate hikes, things staying the same? This is a curveball. So.
Yeah, I do think the weak energy prices are fascinating, and they do because you can see gas station prices posted. These low prices will help to convince consumers that inflation is down. That may improve confidence.
When oil prices crashed in sort of 2014-15, we had surprise rate cuts from the Bank of Canada because there was concern about how weak it was making Alberta and the resource producing parts of the economy. So if you get low oil prices plus some scuffling in the trade war and concern about that USMCA, you could well see rates go lower.
Okay. Well, thanks to both of you for this. Appreciate it.
Thanks a million.
Thank you.
And stay with us. We'll be right back.
One of the biggest investment stories this year has been the surge in shares of Alphabet, Google's parent. It's become the best performing stock in the Mag 7. BNN Bloomberg contributor John Ehrlichman has a news story on our website about Alphabet's big year. John, let's start. Thanks for joining us. Let's start off with Alphabet itself. Why was 2025 so good?
It's funny, Andy, coming into the year, and kudos to a lot of the BNN Bloomberg guests who had flagged the opportunity in this company. But coming into the year, I would say that the skepticism was pretty high for a couple of reasons. One, just there's been some overhangs on the regulatory front with the company. And two, just the simple fact that people didn't really know how the ChatGPT impact on their business would play out, right? They've just got so much in search. And what a difference a year makes. I mean, here over the course of 2025, we saw Alphabet sort of ramp up. Sergey Brin, one of the co-founders, came back from retirement. And now you've got the ChatGPT boss, Sam Altman, screaming code red about the rivals like Alphabet. Gemini 3 just came out. It's wowing a lot of people. The profits are coming in big for this company, which was quickly forgotten, which is something that obviously investors like. And on the regulatory front, they dodged a few bullets. They're not out of the woods, but I think people are now realizing their business is so strong that we feel pretty good about that. Anyway, we talked to Matt Weinshank of Stansberry Research about it, and he's still pretty bullish on the company going into next year.
This is a tough one, but what are some stocks that could emulate that performance in 2026?
So we put that question to Matt in our latest ticker take piece, and he looked at companies that just didn't get a lot of respect in 2025, but have a lot cooking for them going forward. So as an example, you got a company like Adobe, which, Andy, we've talked about before. Because of the AI uncertainty, a lot of people wondered, would they still be able to get people subscribing to Adobe, which is a very lucrative business? The reality is they are weaving way more AI into their business than you might expect. So they're embracing it. They're not running away from it. And that actually might be sticky for their business. Matt Weinshank also flagged as an example Salesforce. Here's a company that is deeply intertwined with the enterprise. A lot of software business, the people, same thing, we're worried that AI might take away. The reverse is actually true. And he also flags Synopsys, which is a company that has tools that help to design some of these AI chips. And it looks like that business is still pretty robust heading into the new year.
And this is interesting. Apparently, quite a few corporations are finding it tougher to squeeze savings and speed and extra profits out of AI. I know it's just early days.
And I think to the point about, let's say, Adobe or Salesforce, just as an example, what if a company, because you guys were talking about this earlier, right? Like, how can you weave AI into your life? What if you're already committed to something and that entity, that business can actually squeeze out some of the cost and make your business productive without you having to change horses? So I think that's the thing that'll be very interesting to watch. We're very much moving into that next phase of AI efficiency. I think that'll be a big theme in 2026 for sure. Whether the companies can do it themselves or the companies that had business models that might have been challenged by AI can actually prove they can get the job done with AI that helps those other companies. So it'll be something to watch for sure.
John, thank you very much indeed. Really appreciate it. John Ehrlichman, and you can find John's story on our website, bnnbloomberg.ca, and on the Ticker Take YouTube channel. Coming up, more on AI. Will it power markets next year? Welcome to the second hour of the Open. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Gold hit a new record high today with futures topping $4,500 US an ounce. Although we have seen some selling as the morning wears on. Spot gold slightly down from yesterday. Escalating tensions in Venezuela, where the U.S. has blockaded oil tankers, and more expectations for rate cuts from the U.S. Federal Reserve have added to the metal's appeal. Gold has soared nearly 70% this year, and it's on track for the best annual performance since 1979. We also saw silver and platinum climbing to fresh records, and copper is headed for an annual gain of about 40%, the biggest since 2009. Factory activity in Canada continued to retreat last month. A flash estimate from StatsCan indicates that manufacturing shipments declined roughly 1.1% in November versus the previous month, driven by large decreases in transportation equipment and food. That would build on a 1% drop in October, which included weaknesses in chemicals, as well as a sharp pullback in shipments of wood products. BP has agreed to sell a majority stake in its Castrol Lubricants division to U.S. investment firm Stonepeak Partners. This is as the oil and gas company seeks to reduce debt and reset its business. The British energy giant will raise about $6 billion US from the sale of the 65% interest. Earlier this year, BP overhauled its strategy to pull back from renewables and focus on its core business. And there is a look at the TSX. It's pulling back right now, very slightly, from yesterday's record high close. Heavy traders today include TC Energy, slipping about 30 cents. Power Corp, though, lots of dollar volume there, and that stock is up about 60%. and the banks are generally higher. Interesting to see Agnico Eagle, which has been such a star, is down. Just a reminder, we have seen gold, which hit record highs earlier, pulling back slightly today. And let's have a look at the U.S. markets. The S&P 500 in record territory once again. It closed at an all-time high yesterday, and it is moving up in early trading very, very slightly. Big traders in the United States in terms of dollar value. The usual suspects, Tesla and NVIDIA. Tesla is actually down about $4. NVIDIA is down about $1. Micron Technology, though, that's had a great week. Those shares jumping another $11. Massive demand for these memory chips means that the company has been able to hike prices. And let's have a look at oil, see how it's faring. We've got the possibility of U.S. attacks directly on Venezuela, and that is holding up oil despite the outlook for global oversupply. And let's get to gold now and see how it's been faring. Gold slightly down from record highs, but we did see that February future breaching 4,500 earlier. And finally, let's have a look at the Canadian dollar. It has staged an impressive rally against the U.S. currency over the past few weeks, and it is holding above 73 cents U.S. right now. Tariffs imposed by the U.S. and massive AI spending drove the markets this year. What will be the big trends in 2026? Where are the opportunities? Let's get more from David Dietz, a Chief Investment Strategist at Dietz Wealth Management Group. David, thanks very much indeed for joining us. I know it's familiar ground, but maybe we could have a quick look at a 5-year chart for the S&P 500, record territory right now. But there was a lot of fear, wasn't there, around April 8th over a potential global trade war?
Yeah, absolutely. And so, I mean, one of the big themes here is that Trump imposed the tariffs and the market just kind of collapsed there, briefly touching bear market territory. And then he pulled back from the most feared tariff increases and the market started to rebound. And for the most part, has continued to move higher on the kind of the back of the so-called taco trade, which Trump's bark isn't quite as worse as his bite, and so that has really helped the market. And of course, at the same time, we've had the continuing massive spending for the AI build-out, focused on those data centers. But ancillary things like the right chips and so forth is driving massive amounts of spending and helping drive this market and economy higher.
The taco trade, Trump always chickens out. I forget. I think it might have been a journalist at the Financial Times of London who made that up. I forget. But I'm sure Mr. Trump doesn't relish that one.
No, absolutely. But, you know, we just saw the latest news is that apparently imposition on tariffs on chips imported into America from China has been postponed for many more months and so forth. So we're still seeing a interest on the part of the administration to kind of reset relationships with China and not exacerbate the trade war there. And I think that's bullish for the markets, bullish for the economy.
Do you think we will see something of a crash for the AI stocks in 2026? I know that's a very hard question to answer, but there's so much aggressive spending, hundreds of billions of dollars announced on the likes of data centers.
Yeah, I mean, you know, the momentum is so strong now. And of course, there is just tremendous amounts being spent. And of course, at the same time, the companies that are doing the spending are extremely strong. They have double-digit earnings and revenue increases. They have very high margins, for the most part, very low debt. So it's hard to see that abating anytime soon. Having said that, I do believe that the Mag 7 as a group have underperformed many of the indexes and so forth. So it just goes to show, just because you're in the pole position in terms of what the top trend is, does not mean that's the way to make the most money in the market.
Let's get to some ideas. You have Fiserv. They're huge in financial technology, enabling money transfers, FISV. Why do you like this name, David?
So this is a top pick here. They're in like the pole position for payment processing, Clover and other types of apps that they have, which allow merchants to process credit card payments and do other types of transactions. This is a stock that was over $230 a share as recently as last spring. It came way down on the back of some really negative earnings announcements, also a transition in the CEO. But having said that, the CEO, of course, has set the bar very low. That's going to make it more likely they can outperform. We still see a company trading about $67 a share that should earn $8.50 next year. So, that's under 10 times the earnings. We've got a decent dividend yield. We're seeing some nice insider buying. This is a company which I think can rebound and do well for investors going forward.
And Diageo, the booze giant, of course, they own Guinness and numerous other alcoholic beverages. Why are you attracted to this name?
Well, certainly we know that the macro atmosphere for alcohol consumption, including, of course, premium liquors, has declined as people are experimenting with other types of substances and just trying to be healthier. Having said that, Diageo is really in the pole position with the #1 brand in so many different categories, including, of course, Guinness, including, of course, Johnny Walker. And if they are taking, I think, the right steps now to streamline the business, to get costs down. Of course, the stock has come down dramatically. And I think these things are cyclical. At a minimum, they'll be able to increase profits by cutting costs and so forth, getting rid of brands that don't do well. And certainly when an industry is under pressure, go with one of the #1 players. That is Diageo, new leadership, bet on this company going forward. And particularly, of course, if people really do lose interest in some of the growth investments, they could come back to something like this.
And apparently on the ADRs for this one, you're looking at a yield of almost 6%, which is pretty handsome.
Certainly in a world where Treasury bonds are yielding a whole lot less and the Federal Reserve could be cutting interest rates, perhaps investors think twice in 2026, having a nice yield that has grown historically with a company like Diageo is a good thing.
And apparently Prince Charles, King Charles, oh my goodness, I'm being disloyal. He pulled a perfect pint this month as he opened a new Guinness brewery in London. And that's not easy, pulling a perfect pint of Guinness, let me tell you. It's a ritual in Dublin. And finally, United Healthcare, UNH. It's had a rough year, but you see prospects for a turnaround?
Again, in an industry that's been under pressure as everyone in the world is concerned about higher healthcare costs. And of course, United Healthcare has had some tough publicity about denial of claims and so forth. But the whole industry has come down. It sometimes makes sense to go with the #1 player because eventually that industry will rebound. And in fact, the #1 player can benefit from some of the smaller players falling off the table. United Healthcare down about 40% this year. But they are forecasting, and analysts forecast earnings growth double digits over the next 5 to 7 years. You've got a stock also where they are going to ultimately cut costs. In the insurance industry, if your claims are more than the premiums, what do? It's so easy. You just start increasing those premiums. And what are we going to do? We don't like to have the healthcare insurance, but we're going to have to pay for it. And so United Healthcare, we're seeing insider trading. Also, I'd like to point out that Warren Buffett's Berkshire Hathaway hasn't bought a lot of stocks this year, but this is one they did back up the truck on, and that's also bodes well for this stock going forward.
David, thank you very much indeed. Really appreciate it, and have a wonderful holiday.
Thank you. Same to you.
David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. Coming up, for years, Samsung dominated the memory chip market until SK Hynix claimed the top spot. We'll have more after the break. For decades, Samsung was the world's leading memory chip maker, but it has been surpassed by a smaller rival, SK Hynix. Is it too late for South Korea's biggest company to get back in the AI race? This Bloomberg doc dives deeper.
When you're out shopping for 7-megawatt offshore wind turbines, you think Samsung, right? Well, probably not. The brand is much more famous for its phones and flat screens. But arguably, the most important drivers of South Korea's biggest family business are these things. And for the first time in decades, the company's got a massive problem here.
Samsung is under assault from all sides, and they are getting stretched thin.
Samsung is in this position of playing catch-up, and that's difficult to do if you don't have growing revenue, if you don't have expanding profitability.
And unfortunately,
the chip profits tumbled. Big disappointment. The semiconductor division reporting operating profit of 400 billion won. Totally missed analyst projections for 2.73 trillion.
Samsung shares have whipsawed in value since their 2020 peak and tanked in 2024, while long-standing rival SK Hynix surged. The crisis is easy to miss amid all this.
The Ultra experience is ready to unfold.
But behind the cats and choreography, Samsung's hidden struggle threatens its national identity amongst a population that relies on it like no other.
It is probably the most influential company in Korea because of the importance to the economy.
And maintaining that influence may hinge on a piece of technology you probably own but have never even seen. The Samsung Group comprises vastly more than just its flagship electronics empire.
You can literally be born in the Samsung hospital, go to a Samsung school, live in a Samsung apartment, you work at Samsung, you come home, you put your food, which is made by Samsung, in the Samsung microwave and turn on your Samsung TV. It's a company with 400,000 employees all over the world. They make chips, they're in shipbuilding, they make apartment complexes.
Samsung is the biggest company in the country. It is the biggest weighted in the Kospi index, which is the local stock market, and as well as the biggest contributor to the economy by any study that you can see.
Samsung, in any given year, makes up about 1/5 of the country's exports. Imagine there's one company that's selling 1/5 of all the goods produced in that country. I mean, that kind of comparison doesn't exist anywhere.
You get the idea. A career without Samsung is a Blackpink show without the superstars or their iconic light sticks.
Samsung is so tied to the health and well-being of the South Korean economy that you just can't imagine a South Korea without it.
So why is such a scenario even being hinted at? Well, for years now, electronics have driven Samsung, and not just these things.
Its major product is computer memory, so-called DRAM or dynamic random access memory. Those chips go into everything from smartphones to the world's largest supercomputers.
Samsung Electronics' semiconductor business has typically accounted for between 50 and 70% of the company's profit every year, and is central to its evolving crisis. So it's worth understanding how these chips work.
Think about DRAM as a coffee cup. Imagine you want to drink as much coffee as you possibly can from the coffee pot, but you can't pour that coffee pot into your mouth, so you have to do it via a cup, right? Depending on the size of the cup, that will determine how much coffee you can drink in one go. Think of DRAM as that coffee cup. What Samsung's chips do is they hold that information ready for when the processor wants it.
But what that information is, and the kind of processors using it, has evolved radically.
AI has changed everything. Samsung, which dominated the memory market for decades, is now struggling to keep up with the latest technology.
So, what went wrong?
SK Hynix, lead the future!
In 2013, SK Hynix and AMD teamed up to develop high bandwidth memory. It was the first product that was in the market. But at the time, it wasn't clear what it was going to be needed for. It was mainly for the gaming industry that they were kind of developing. It was a niche product.
But that's often how things go in the semiconductor world. Build the stuff and let the industry figure out how best to use it.
The chip industry, it operates on these 3 to 5 year cycles. You have to make massive billions or more dollars investments 5 years ahead of time sometimes. And, within those 5 years, a lot can happen.
And over the last 5, a lot did.
The release of ChatGPT has really changed everything. All of a sudden, there was a surge of demand for HBM chips, which is really ideal for AI applications.
Remember this? AI needs vastly more coffee, or data, and it needs to swallow, or process it, faster than ever. HBM, high bandwidth memory, made that possible and is now a fundamental component of the accelerators used to train large language models. At the time, Samsung hadn't invested enough in this kind of chip, which is a type of DRAM but significantly more profitable than its mass market counterpart. But a smaller, local competitor that had teetered on bankruptcy as recently as 2002 had.
SK Hynix has come arguably out of nowhere to become a major rival, to have unprecedented success against them.
SK landed the contract with NVIDIA, which is the largest maker of AI chips, these logic chips in the entire world.
You'll have seen the headlines about what that's meant for NVIDIA's investors. But the knock-on effect for its most important suppliers has been great too, particularly for SK Hynix.
It's reported record quarterly profit that beat expectations, driven by its dominance in high bandwidth memory.
SK Hynix's profit has continued to soar to record highs in the last year on the back of the AI boom, inspiring investors to pile into its stock and elevate that to historic levels as well.
SK Hynix is providing about 20% of NVIDIA's cost of goods sold. It's the second largest supplier of semiconductors to NVIDIA, behind TSMC. Samsung is about 1% of NVIDIA's cost of goods sold, according to our analysis.
Samsung is trying to really catch up, but it's very difficult.
This year, Samsung was overtaken by SK Hynix in the DRAM market, ending its 3-decade lead. US manufacturer Micron isn't far behind either.
And so this is devastating for the company.
The company's vice chairman has issued an apology, a rare apology. It was a long one.
It was quite an extraordinary mea culpa from the head of the chips division.
The way it works in South Korea is that the company is an arm of the nation. It's a private company on paper, but they're expected to represent the interests of the South Korean people.
And that's been the case for quite some time.
Samsung got its start in 1938.
This was at a time when South Korea as a nation was extremely poor. It was actually one of the poorest countries in the world.
They started as a sort of a very small trading company for dried fish, rice, that type of business.
And gradually, on, they expanded into these more complex industries until they finally got later into shipbuilding, into oil rigs,
into the aforementioned offshore wind turbines, and of course, into electronics, which are now at the heart of its problem. So, what does Samsung need to do? Well, first, it may have to win over the undisputed world leader in AI hardware.
Samsung chips have been left out in the cold because they haven't passed the tests required by NVIDIA to become a contractor.
All they've said publicly is, we want Samsung to be better, we hope they'll get there, we're sure they'll get there. But clearly they're not buying from Samsung right now, according to the numbers.
Samsung is now mounting an all-out push into next-generation HBM4, aiming to close the gap with SK Hynix. On recent earnings calls, Samsung executives have acknowledged as much, but they also say its next-generation custom chips have been drawing great interest from the industry. But it'll take some time for the money to show up from sales of those. Samsung doesn't just design and manufacture its own chips, like those NVIDIA needs. It also has a foundry business that only manufactures chips other companies design. And this is under intense pressure too, particularly from Taiwan's TSMC, which controls about 2/3 of the global foundry market.
The most recent quarter, Samsung has about 8% market share, and they're struggling to gain large customers.
There may be some light at the end of a tunnel, though. In July, Samsung said it had reached a $16.5 billion pact with Tesla to produce its next but one generation of AI semiconductor.
Some say that it's not really significant when you really break it down to annual numbers, but it is a big deal when it comes to its foundry business that a lot of the investors have thought was actually dormant.
That foundry battle is one the South Korean company will have to keep fighting, alongside the one with SK Hynix in the memory space.
On the logic front, TSMC is just going over the horizon on everybody and is increasingly dominating that very profitable market.
I think there is a bit of a lesson that we can learn from all these giants, that, you're successful today doesn't mean that you will successful tomorrow.
Just look at Intel. Intel in 2021 was the world's largest chip maker. Now it's well down the ranks. Samsung is not in the Intel camp yet, but it could be. And that's the concern that Samsung investors have, that Samsung insiders have.
Coming up, we're going to bring you some notable calls from analysts, including a verdict on WSP Global's latest big acquisition. Let's check out some notable analyst calls and recommendations. Scotia is lifting its price target on WSP Global, the giant engineering company, to $318 from $308, and sticking with an outperform rating on the stock. WSP just pulled off a massive acquisition of TRC companies in the United States. It specializes in electrical projects. Scotia calls this deal a home run, says that it's going to add to organic growth and also profit margins. Scotia saying that it sees upside to estimates, given WSP's history of conservatism in the deals that it does. And our second notable call is on OpenText. Citi is cutting the firm's price target on OpenText to $36 US from $38, and sticking with a neutral rating on the shares. The company says management entities are facing a stable but uncertain demand environment with some relief from the reopening of the U.S. government. Of course, OpenText is a major supplier of software, and the U.S. government shut down tough on vendors to the U.S. government entities. Citi says, in fact, Pegasystems, P-E-G-A, is its top pick, saying that company is a leader in artificial intelligence monetization. It also cites opportunities in Blackline, BL, and Workiva, WK. Coming up, we're going to bring you the latest headlines and update you on the markets. Shares in First Quantum Minerals slipping a little bit today, but that stock has pretty well doubled this year. The company has agreed to sell the Las Cruces mine in Spain to Global Panduro for up to $190 million, plus additional payments tied to profits. Panduro says the deal will let it further develop the Las Cruces polymetallic primary sulfide project. Shares in Dynavax Technologies soaring. Sanofi agreed to buy the drug manufacturer for about $2.2 billion US as it seeks to expand in vaccines. The deal gives Sanofi a hepatitis B vaccine that's already sold in the United States, as well as an experimental shingles vaccine. This comes as Sanofi continues to face challenges, including a rejection by US regulators for a crucial product and a decline in global vaccine rates. And shares in Intel slipping after a report that NVIDIA has halted a test to use the company's production process. Reuters says that NVIDIA recently tested the so-called 18A process to make advanced chips, but stopped moving forward. In September, NVIDIA agreed to invest $5 billion US in Intel after the US government's decision to take a roughly 10% stake in the company. That deal, however, did not include a commitment for Intel to make NVIDIA chips. And we've got the TSX slipping a little bit from yesterday's record high close, but the S&P 500 pushing further into a record high territory, and the Nasdaq Composite drifting down. It's a tentative agreement that could turn the page on a tumultuous chapter of labor unrest. Canada Post and the union representing postal workers say they have found common ground, but there are lots of questions about the future of the Crown Corporation. CTV's Scott Hurst has more in this report.
Labour unrest between Canada Post and its union representing 55,000 postal workers and uncertainty about the future forced this Toronto small business to make a choice.
We had to go a different route this holiday season.
Retailer Province of Canada ships clothing across the country, and by turning away from Canada Post, is now relying on multiple carriers to fill the gap.
After last year's strike and then this September, we just didn't feel we had the confidence to go into the holiday season with them again.
But a tentative deal between Canada Post and the Canadian Union of Postal Workers announced on Monday may at least provide some stability.
So on the one hand, short run, good news. In the longer term, it doesn't solve the underlying structural problems.
Canada Post said the agreements include a 6.5% wage increase in year one, a 3% hike in year two, and increases matching inflation in years 3 through 5. They also include enhanced benefits and a weekend parcel delivery model, which had been a key sticking point in negotiations.
They are still bleeding. They are hemorrhaging incredible amounts of money. So they're a long way away from where they have to be. They've got a huge job ahead to become more dynamic and productive and competitive.
And maybe that will be enough to win back at least this Toronto business.
I think until this gets fully sorted out properly, then we can maybe reconsider going back to them for next year.
Cup W's national board is recommending its members accept the deals. Ratification votes are set to take place early next year. Scott Hurst, CTV News, Toronto.
After this, we are going to talk to the founder of Craig's Cookies, formerly an actor. He created a cookie empire across the nation. So we're getting ready to leave out milk and cookies for Santa, ce soir. And speaking of cookies, we heard from Craig Pike, owner of Craig's Cookies. He told us how he has spent a decade creating a cookie empire across Canada. We kicked things off by asking how the former actor got his start.
Well, I thought I would maybe sell cookies to my friends on my bike. It's my mom's recipe. And so I hopped on social media, said, does anybody want a cookie? Somebody did. I biked them over to Parkdale in Toronto and sold about 200 dozen cookies that first month, just kind of popping around. And then for the next 5 years, I just kind of did that and then opened my first bricks and mortar in 2018. And now we have 23 locations across Canada.
They're all but one are in Ontario. You've got one in St. John's, Newfoundland, where you have roots.
I'm from Newfoundland, so we have one in St. John's. We just opened in Calgary about 2 weeks ago, and we're set to open in Halifax early 2026.
So what's different about your cookies? I know you're going to say they're the best in the world, but what's distinctive about them?
Well, they are the best in the world, but it's my mom's recipe, so it's, homegrown. And what I did is I started putting little chocolate bars, like my favorite chocolate bars, inside the cookie. So it started with an Oreo, actually, and then like a Mars bar, peanut butter cup, Twix bars, and now we'll put anything in a cookie. We've put chicken nuggets in cookies, pizza. Yeah, absolutely. It was a huge hit at the CNE last summer. You dipped it in barbecue sauce. So kind of the world is our oyster, or the world is our cookie when it comes to flavors and what we put inside those little beautiful biscuits.
Now, I believe you have about 14 franchisees and about 7 corporate stores. My numbers may be a little low there, but so you have both. Your model has both formats.
Yes, exactly. During COVID, we saw growth within the company. Everybody wanted to send folks sweet little treats. And then I saw that as an opportunity, that growth, to be able to expand the business. And we decided to go down a franchising model.
Steve Rolls, do you have a question for Craig?
Yeah. Hi, Craig. Great to meet you. And I've been to the new store in Calgary on 17th, and fantastic, great location, and great success. You can do very well there. I have a question. You're just talking about franchise, and I have a few clients who have some franchise businesses, and maybe you could just expand on your model for franchise, and second part, maybe describe how the franchise model for in Canada and how strong it is?
Yeah, I think there's a lot of growth right now within Canadian businesses and Canadian-grown businesses. I think what's happening internationally has had the consumer really reflect on where they're spending their money, and we're seeing so much support for our business, being a Canadian business. Within the franchising model, I really love giving folks the opportunity to be able to also now run their own businesses. For me, one of the most important parts, obviously, we want to work with people that have strong business acumen, but also that have strong ethics and strong morals and within capitalism in a way. I think because I come from the arts, it's really important for me to be able to offer really great spaces for people to work. We offer benefits, we offer GRSP programs, and really great incentives for people to work at Craig's Cookies. And then me as a member of the queer community, it's important to be also like socially active within our communities. So that's a really important, like I said, component as far as when I'm meeting potential franchisees and where we open. So if kind of the measure of growth is quality over quantity in a way.
Yeah, that makes a lot of sense, and it's really seems like you're really dedicated to creating the culture, which is everything. So if I go to the one in Calgary, or go to in Toronto, I'm getting the same type of service. But one other question, whenever I talk to successful entrepreneurs, is what was your greatest failure, and what did you learn from it, and how did it make you successful?
I think my greatest failure happened actually when I was an actor that I was able to bring into business. I was so afraid of listening, and I was so afraid of being my authentic self within the craft of acting. And I remember I did a play back at the Shaw Festival years ago where I was really challenged to think outside the box and not be afraid to say, hey, I don't know what I'm doing right now, and then rely and and receive support from people that are better than me. So I was able to learn that before I even opened Craig's Cookies. So since starting Craig's Cookies, I've really, really relied on people that are smarter than me. I didn't go to business school. I didn't go to baking school. And so what I've learned is literally from people that are smarter than me, and to be all right with saying, I don't know. And then educating yourself and learning about what you may not know about. That's an important component to it. And also really, really deeply listening to people. And trying your best to be able to meet their needs, whether or not that's an employee or somebody that comes in and they're like, hey, do you have this, like my favorite cookies Nutella? And if we don't have it, it's really important as we grow. When you talk about franchisees, it can be, you can lose control over your business quite quickly, and how to hold on to that kind of small mom and pop feel. So if somebody comes in and we don't have a cookie that they really want, let's take the time and effort to make sure that the guest gets an hospitable and really careful experience when they come into our stores. I think hospitality is so important. I guess that's the Newfoundlander in me, and to try to put that first and foremost is also really something that we strive for.
Craig, I always admire independent business people. How do you handle the red tape and the bureaucracy between worker safety and I know it's important, but revenue agency, health and safety? Does it not drive you up the wall, all the form filling?
It's a really important part of the process. It is also, I think, we are living at a time where things have changed. The workforce has changed. I think so. That can be challenging. I have a very great therapist who helps me through a lot of that, and really great team members that support that as well. And like I said, when we offered our benefits program, it was really important that a component of that was for mental health. So yeah, it can be challenging. It's definitely different from what I'm really good at, which is pretending to be other people in the arts and being an actor and a musician. But it's one day at a time. And like I said, it's really about just listening and staying calm.
Craig Pike, the owner of Craig's Cookies. Coming up after the break, we'll get a rundown on what to consider when making a will ahead of the new year. Judy Severus is up next. joyful time of the year, but in the early part of the year, it could be time to fix up your first personal finances, especially your will. Let's get more on this from Julie Sabaras, Head of Wealth Planning and Practice Management at Manulife Wealth Management. Great to see you.
Great to see you.
And it's incredible. Half of Canadians don't have a will.
Absolutely. And when it comes to financial planning, this is a really important part of your financial plan, but it often tends to be an afterthought or something that we procrastinate.
Mm-hmm.
And this is why I always think there's so much value and advice in working with a professional such as a financial planner or a financial advisor, because they're often the ones that are going to remind you that you need this, and as well as nudge you to take action, because it's not uncommon that when you meet back with your financial planner, did you get your will? Oh, no, I haven't done it yet. So they help you take the action. So I really hope that 2026 is the year that 50% of Canadians that don't have a will do take those steps to getting one.
Because essentially, if you die intestate, the province is in charge of administering your estate?
They're in charge of the formula of how it's going to be distributed. So when you draft a will, that's where you would, one, name an executor. You would also name a guardian for any minor children, and you would outline how you'd want your assets to be distributed. Well, if you haven't drafted this document, you haven't done any of the above. So now somebody will have to apply to be your executor, and they'll be the ones that now look after all of the administration and paying the taxes and paying the debts and distributing the assets to the beneficiaries. And then they'll have to use the formula that is applied as per the province.
So somebody steps in to do this.
That's right, exactly.
How is that person suggested or selected?
So it's really somebody that steps forward. Often it's a family member or maybe a friend of the family. Now, if there's one person who steps forward, this can be a little more straightforward. If you have multiple people, that's now got to go through the process. This now just takes time and can be legal fees, and it really just delays the whole process. And so this is why things are so much easier if you just put these documents in place and make sure that they're there. Now, not only do you want to put them in place, but you also want to make sure that your family members understand that you do have these documents, where they are located.
And passwords.
And passwords. And the person that you've named as the executor, we want to make sure you've had a conversation with them, because it's not unheard of that an executor finds out by surprise that they have been named to look after your estate. And they may or may not want the job. And so you need to make sure that they're aware, and then also communicating what you'd want your wishes to be.
Yeah, you and I talked a little while ago about how many people just don't want to be an executor.
Yeah, it's seen as being an honor, but the job itself can be hundreds of hours.
Yeah.
And then you add in that it's an emotionally charged event. Also, you have family dynamics.
You could have fights.
Absolutely, you can have fights. And so you want to make sure your executor start thinking about the dynamics they have with your beneficiaries, and is this going to be a smooth process to administer your estate?
And there's often complications with common law spouses, especially if you've separated from an actual married partner.
When you have a blended family, that now starts to introduce some complexities into an estate, especially if you have children from previous marriages and children together, especially. So this is when you absolutely want to be engaging the right professionals to draft your wills. So this can be, complexities can include, like I said, blended families. You could have disabled dependents that you need to make sure that you're providing for, business owners. So really working with the right professionals to get the documents in place that are set up correctly to make sure this goes as intended, because these situations can often end up in unintended consequences.
And all too often, families get kids or the heirs get into disputes over who gets what.
Exactly. So you want to make sure that this is not just documented in a very clear way, but it is documented in a valid method to make sure that it's going to be applied, and that you've communicated that with your family so they understand what you've done and why. Things are not always equal. We often talk about fair versus equal in estate planning, and there may be a reason that you've done something that's unequal, but you'd want to communicate that to your family so they understand why you've put those things into place.
One kid may not make as much, maybe through no fault of their own, or who knows.
Exactly. It could be financial situations. It could be estrangement. Again, we always see different family dynamics, and there could absolutely be reasons for these valid reasons, but communicating will then now eliminate possibilities of it being disputed down the road.
And if the province gets involved, you're dealing with public service delays, I presume. Any
Yes.
public service is going to be vulnerable to that.
It's a process. And so you have to go through the process. And this can easily add months and months to the process. And during that time, nobody has the right to act on behalf of that individual who has passed away. So you're essentially at a bit of a standstill until you can start now going through the required administration for that estate.
Yeah, you got me thinking now. I should be writing down my passwords at least to give people a break.
Yeah, for your executor, you absolutely want to give them access to your passwords. You want to let them know where your important documents and assets are. So again, these are part of the conversations that you're going to be having with the individuals who will be looking after this for you. And of course, we want to go back and update that will for life events such as marriage, divorce, birth of a child, changes to your wishes, changes to who you want to be your executor. And also consider naming a contingent executor in case the person that you've named can't act for whatever reason. Maybe they've passed away before you, maybe they don't want to act. And you can also name a corporate executor. So this can be a trust company or a professional who can act. Maybe you don't have a friend or family member who's the right person for this.
No. What kind of a fee, though, will a professional get?
So any executor, whether it's a family member, whether it's a professional, is entitled to 5% of the estate assets. And this is an automatic rule. This does not have to be mapped out into the will.
Okay.
And so, whether it's a family member or a professional, it could be up to 5% of the estate assets.
Can they charge more than that if they say, well, look, this is very complex?
Their fee could be their fee, and you would have agreed to that when you've entered into it. But it tends to be in the same neighborhood.
Yeah. And I can see if people have assets abroad or they've moved from another country, that could complicate things too.
Yes, and this is where you would want to engage those professionals. Cross-border assets, that is definitely something that's going to introduce some complexities, and you want to make sure that you have the right individual that understands the rules in both of those jurisdictions, any tax filing requirements, and all of that goes with it.
One of my favorite scenes in Shakespeare, Mark Antony has Caesar's will, and he says to the Roman mob, I can't read this to you. It would make you so mad at the people who murdered Caesar. I can't. Of course, he reads it. That's the whole plan. Leave us with a final thought. Is there a big mistake that you find in wills other than just not doing one?
There's so many, and this is why you want to engage the right professionals to make sure that whatever your wishes are, that they're documented appropriately, and you're not going to end up with unintended consequences. And I hope this is a goal for 2026.
Okay. Julie, thank you very much
Thank
indeed.
you.
Julie Sabaris, Head of Wealth Planning and Practice Management at Manulife Wealth. Do we have time to have a quick look at the markets? I think we've got a minute or two. Let's have a look at the TSX. Whoops, down from yesterday's record high, but the S&P 500 is in record territory, and the NASDAQ is holding its own right now. Of course, we've got quiet Christmas Eve trading, and I have to go out and do all my shopping now. I've left it to, I always like to leave it to today. Let's have a look at how some of the big commodities are trading. Gold hit record highs earlier, has slipped from those levels, but we did see the February futures getting north of 4,500. And we did also see the spot price of gold going north of 4,485. And that's roughly where the February futures are right now. First Quantum, it's had a great year, announcing the sale of a mine in Spain. And there are high hopes that that huge shutdown mine in Panama will be open before too long. The Panama government does seem interested in getting that giant operation going again. And let's have a look at Agnico Eagle. It has come off its highs. At least one analyst has talked about the valuation getting stretched, but it's had a magnificent year. And look at that. It's up almost threefold in the past 5 years. Thank you very much indeed for watching The Open.